So the best trade today from the ES, which is the S&P 500 for the index futures market, would have netted you a total of $3,375, and that's if you entered right at the bottom here and exited right at the top. But of course, that's just theoretical, right? But let's stick around to see how our strategy would have fared on the market today and see if we would have been able to make the entry at the right point. How's it going? It's Rocky. Before we get started, just want to give a disclaimer. This is for informational and entertainment purposes only and should not be relied upon as a basis for investment decisions. So what we have up here is the S&P 500 equivalent for the index futures market, which is the ES. And what I have on the left screen here is a time-based chart, and on the right side is the tick-based chart. So if you ever were curious about the explanation of these, I do a lot of examples on past videos, and the entries and exits that I make, it's actually in the description. So again, this is all theoretical, but the point that I'm trying to make here is to see if our strategy would have been able to enter right at that low and exit right at that high. So we're just going to zoom in into that area that we care about, which is the low and the high for the day. All right, so we'll draw a vertical on both sides, the left and the right side. And first, we're going to actually take a look at this right side here on the tick base side. I'm going to zoom in a little bit more because, yes, it would have been great to hit that bottom, but that's unrealistic, right? Trying to hit that peaks and bottoms could get you in trouble. I just want to essentially adjust based on what I'm seeing on the candle and what I'm seeing on the indicators. I want to see where I myself would have entered if I was paying attention to this trade. And in reality, I think where I would have entered is, let me adjust this, probably be right at this 645 candle. And the reason that I would have entered at that time is because you see here the MACD crossover. So MACD crossover just occurred, so this is a bullish sign for me. And then if we look at the stochastic RSI, we are on the overbought side, and that's when I normally like to go long. So this is just my experience. I know it's very different from how others may do it, but this is just how normally I would go long in a position. And then just looking at this one, that was roughly on the 645 candle. So we're gonna go back here to the left and try to see right right there. So it's perfect. So the blue line that we drew here is right at the 645 candle. And then if you look here, you see that we are also not quite there, but headed on to the overbought side. And on the crossover, it actually would not have occurred yet. So in reality, I probably would not have entered on this candle, but at the same time, with you know, just because I was seeing it on the right side and on the left side with that range. Again, you wouldn't have seen that, but the 18.75 point range momentum is there. I'm sure I would have jumped in on a bit more aggressive entry on this one. And let's just say, just for the sake of it, that we would have entered maybe roughly at 4,218. I think that's a good number. So 4,218 right on the right side there, because that's what the candle I would have entered. So I'll just draw the equivalent 4,218 on the left side as well. So with this one, there's probably would have been a potential of three exits to take. First exit that I would have taken is right here, exit number one. Second exit probably would have been right here, exit number two. And the third exit would have been right here. So with this exits, normally when I'm up a bit of a profit, I usually put a trailing stop right following it. And I know that with this drop right here, my trailing stop probably would have been taken out. And then if let's just say I didn't have a trailing stop and I just had a static stop and you just manually adjust it, that's another strategy you could use. Another one would have been on the second one here. I probably would have been stopped out here with my trailing stop. But definitely on the third one, I know for sure that I would have been stopped out by this move right here. So, risk management, just be careful of that. You can have a manual stop or you can have a trailing stop. For me, I like trailing stop because it takes the decision making out of it. It's just following it. But the downside with the trailing stop is, of course, moves like that occurred on here, right? You see that it would have taken your stop out and it would have left you going all the way up. So that could have been pretty problematic. But that's one of the reasons that I use the tick base. Again, if you look at the tick base on the right here, just showing you where those equivalent exits are, it really helps me make that decision to see. It really helps me see the momentum, right? And with this one, definitely I know that it could have reversed on me here. However, when we look at the indicator, you see that right here, it was not on the oversold side, so I wouldn't have been worried. The second one, it definitely is in the oversold side, so that's why I am pointing that out as a potential second exit. But let's just say your stop was wide enough. It would have been until the third one right here, where we definitely would have been stopped out. But yeah, just showing where an ideal entry would have been and the three potential exits that could have occurred for today. And then next, let's just say you hit the top. Again, this is, I know, theoretical, but just the potential of what could happen, right? If you exited at 42.80.75 and you entered right at the bottom at 42.13.25, but let's use the example of 42.18 that I used. That would have been 62 points, which would have been amazing for the S&P 500. And because with the S&P 500, every point is $50, and with every point there's four ticks, so there's 25-cent ticks. And for each one tick, which is 25 cents, that move will give you $12.50. So the numbers are a little confusing. That's why it's just easier to think of it as for every point it's $50. So with this number of points, we'll multiply that by $50 and that would have been over $3,000 from this trade. So there's the potential there, but what I'm trying to point out is when you trade the ES, you only need one contract. That's all you really need. And this is how I've been successful when I used to trade my own money because I didn't have a lot of money. So I was actually limited on the number of contracts I had, which is a juxtaposition from me trying the Apex Trader funding right now because I'm allotted so many contracts that it's a battle internally for me right now to stop at just one contract. And yeah, I'm just being vulnerable there. I'm showing you or telling you why I haven't been showing much of a result the past month and a half. Um, yeah, I'm hoping to change that. I'm hoping in the future I can show you, hey, look, I'm finally overcoming this problem by using a funding firm. But as of right now, I'm just going to keep my content like this. Hopefully you like it. Hopefully you enjoy it. Give me some feedback. If not, well, check out the other videos or wait for next week and we'll see if it's a content that you do enjoy. All right, y'all have a good one.